The US dollar continues to remain soft at the start of this week trading session as the US dollar index has continued to trade below its 50-day moving average since 2 weeks ago. However, the softness in the US dollar in general did spread on to a broad-based risk-on behavior in the global stock market due to jitters on AI-related stocks that caused the Nasdaq 100 to sell off yesterday. Interestingly, this sell-off didn't spread to the entire US sectors, where we start to see pockets of strength in the financials, the healthcare, as well as the industrial stocks that allow the Dow Jones Industrial Average to outperform. Oil, West Texas crude oil, broke down below a minor range support at 57.20, reinforced by potential breakthrough in Ukraine-Russia peace talks. Very good morning to all. I'm Kelvin here from OANDA, and welcome to today's Daily Dose of Market Insights. Today will be Tuesday, the 16th of December, 2025. So today will be a very interesting Daily Dose session. Why? Because we will have a potential volatile session at the start of the US session thereafter due to the release of this daily non-farm payroll data and as well as slew of PMI releases globally as well. So we'll take more about that in a greater detail. All right. So before we start, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so before we jump straight into the refresh intraday key levels / outlook on the broad-based cross asset classes, let's have a quick look at what has taken shape yesterday and as well as in today's early Asia session in relation to the news flow and data releases. All right, so let's start with the state of the US stock market first over here. So what we could see is that the state of the US stock market was rather lackluster yesterday. If you were to look at those indices that are heavily weighted towards the mega cap technology stocks that is directly or / indirectly related to the AI high productivity narrative team play in the last 2 to 3 years that has been underperforming in the last 3 to 4 weeks due to AI bubble fears, continues to weigh on the general sentiment in the US stock market yesterday. So the S&P down negative 0.16%. The worst, we call it the underperformer was the Nasdaq 100 down negative 0.51%. However, the Dow Jones Industrial Average managed to close almost unchanged at negative 0.09%. The Russell 2000 also followed the trend of the Nasdaq 100 down by negative 0.81%. So the culprit that causes the underperformance of the Nasdaq, which was down negative 0.5%, was due to the continuing bearish sentiment of AI-related team play stocks. All right, which has a higher weightage in the Nasdaq 100. So what I could see over here is that despite NVIDIA, which managed to close up 0.73% yesterday, but however, other semiconductor names within the semiconductor group cohort in the US stock market was underperforming. It was underperformed. So Broadcom down negative 5.6%, AMD down negative 1.52%, and Micron down negative 1.51%. And that actually spread into other mega cap technology stock as well, where Microsoft is down by negative 0.78%. Oracle continues to weigh on the market, down negative 2.66%. Apple down negative 1.5%. Amazon down negative 1.61%. But we start to see pockets of green within the financial sector over here, healthcare, industrial, and as well as the consumer defensive, the consumer staples. So if we look at from a sectorial performance basis, healthcare, utilities, defensive, consumer cyclicals, and financial all managed to close in the green. All right, 0.89% for healthcare, utilities 0.76%, consumer defensive / staples 0.31%, consumer cyclical up 0.25%, financial up 0.15%. The worst hit were the technology sector, down negative 1.19%. So that causes the Nasdaq 100 to underperform. But however, the Dow Jones Industrial Average, which has higher weightage in healthcare as well and and financial sector managed to close almost unchanged yesterday. All right, so over to the FX market. So if you look at the FX market, the dollar continues to weaken. All right, so what you could see over here is that based on this 5-day rolling performance of the US dollar against other major currency, it continues to slope downwards, where the dollar index is down by -1%, supported by the US 2-year spread versus the 2-year government bond spread of a key developed economies, Germany, UK, Japan, Canada, Swiss, Australia, Canada, that is continues to slope downwards. So that has a direct correlation because the 2-year treasury yield is a traded instrument, and the 2-year treasury yield is being derived by the price action of the 2-year treasury market. And the 2-year treasury market has a very close proxy with the monetary policy of the US Federal Reserve. So if the 2-year US Treasury yield spread continues to narrow against the 2-year government bond spread of these key developed economies on the simple weighted average, it actually potentially adds downside pressure to the US dollar index. And as we are speaking right now, the dollar performance is the worst against the Japanese yen, which is down by -1.37% as we are speaking right now. So this is the 5-day rolling performance as of 16th of December, as of 11:10 a.m. Singapore time right now. So basically what causes the dollar to be the weakest against the Japanese yen based on this 5-day rolling performance basis? Because right now we have more evidence that Bank of Japan will potentially increase for the second time this year on this Friday monetary policy meeting to rise its benchmark policy rate by another 25 basis points to 0.75%. So yesterday, there's this Bank of Japan survey that indicated that potentially there could be further progress on the wage front. Okay, so we know that two things in order for Bank of Japan to hike interest rate was stabilization in inflationary trend, which has been stabilized for the last 2 years above the 2%, and also a continuous improvement of wage growth. All right, so there's this survey report that they sent out to corporation, and they mentioned that most reports from the head office and branches mentioned that firms expected to rise wages in fiscal year 2026 at about the same rate as fiscal year 2025. That means next year there's going to be a similar momentum of wage growth, same momentum as in this year when high wage growth was realized. BOJ said in a report on Monday. And based on this, we call it positive report, that also gels in line with previously public speeches by Governor Uda that's highlighted earlier this month that the bank will actively collect data on wage increases so it can make an appropriate decision on rate hike at its meeting ending Friday. So more or less, the data now supports this rate hike coming forward on Friday. So that is almost 100% being priced in the market. So now market is now expecting the forward guidance by Bank of Japan will continue its gradual normalization monetary policy. So potentially there could be another one more interest rate hike in 2026, at least for now. So that actually causes the dollar yen to be the weakest major dollar pair based on the 5-day rolling performance as we are speaking over here. All right. Come on. Yeah, as we're speaking. All right. But what's interesting over here is that now there's a K-shaped performance, and the K-shaped is reverse. The dollar now is strongest against those higher risk beta currency, the Aussie and the Kiwi. Don't bear in mind that the Aussie is very, very sensitive to risk on, risk off sentiment in the global stock market. So what we could see right now over here is that the Aussie dollar actually shed against the US dollar. That means the US dollar strengthening against the Aussie in today's Asia session due to a general weaker sentiment in global stock market caused by the sell-off in AI related technology stocks that dragged down the Nasdaq 100 yesterday, and that has a negative spillover impact to the Asia Pacific market that do have AI related names in their component stocks inside their benchmark index, like SoftBank, where Nikkei 225 is down by -1.28% right now as we are speaking. And also the Hang Seng Tech is down -2.42%, dragging down the Hang Seng Index, which is down by -1.9%. And if you go down to over to Asia, that also starts to spread as well. where the STI is down by negative 0.19%. The ASX 200 is down by negative 0.35%, caused by this rather weak consumer sentiment data that is out from Australia at the start of today's early Asia session before 9 a.m. Singapore time. All right, so at 7:30 a.m. Singapore time, there was this release of this Westpac Consumer Confidence Index for December that actually dropped to 94.5 from 103.8. All right, so that also causes a drag on the local, we call it Asia Pacific stock market sentiment to be skewed towards on the negative side due to this barrage of negative data coming out in today's Asia session. And if you look in the at 6 a.m. today will be the release of all S&P Global Flash PMI data. So this is all considered as a forward-looking data, given that it's survey-based. So for Australia, the services PMI data flash for December came in below from the previous print of 52.8. So previous December print of 52.8, it came in at 51. So this is also anything that's above 50 showing growth is still growing, but right now the growth rate has started to slow down, okay, based on the December print. And also that also being seen on the manufacturing, not so much. Manufacturing slightly improved to 52.2 from 51.6. So it's more like a mixed reading over here for the PMI preliminary reading for December for the Australia economy. So net overall, given this mixed reading and the Westpac consumer confidence change that came in below from the previous month print of 103.8, that actually dragged down the Aussie dollar in today's Asia session. But what's interesting over here, the Aussie dollar is now trying to fight back to the 66.30 level. So later I'll touch on what are the key levels to look out for when I cover the intraday outlook on the Aussie dollar. All right. Then going forward about oil price. So oil price continues to tumble and did that bearish minor breakdown. It can't do that bounce from 57.21 due to this ongoing breakthrough that right now there's this negotiation or talks between European leaders, Ukraine, and as well as US negotiation team that US now decides to offer Ukraine security guarantee, because previously US didn't actually offer that, but Ukraine need to actually drop its bid to join NATO. So with this US negotiator offer Ukraine Article 5, like Article 5 is like NATO, but so once Ukraine agreed to this US security, then Ukraine potentially will start to reduce its bid to join NATO, and that could actually offer Russia to come to the negotiation table to potentially end this ongoing Russia-Ukraine war. So given the fact that then Trump also mentioned that the negotiated end to the war was closer than ever, but suggested that Ukraine ought to give up some land as part of the deal. So potentially there could be some promising breakthrough going forward in this this Ukraine-Russia peace talk that could potentially end this war. And given this promising breakthrough, Russia could allow its stockpile of oil to flood into the global market legally. All right, over here. So bear in mind that given this ongoing Russia-Ukraine war, there's still ongoing Russia oil is being sanctioned by most of the world, unless you just to go through we call it the dark fleet now, where it flows through illegally. So from a legal perspective, Russia oil has been sanctioned. So given that if this Russia-Ukraine war has could finally potentially end, as based on this promising talks that is ongoing, that could actually increase global oil supply. So that actually causes oil prices to plummet yesterday. So later I'll touch on the latest key level and trend bias on the intraday basis for the West Texas crude oil. All right, so that sum up the first segment of the daily dose. So before we go into the second segment, let me very quickly share you guys what are the CME Fed Watch 2 probability for that expected rate hike, rate cut, or rate hold on the next upcoming FOMC meeting based on the current Fed Funds Futures traders price action behavior as compiled by the CME Fed Watch 2. So the current Fed Fund rate now is 3.5% to 3.75%. That was being cut. That was being adjusted to the downside on the third interest rate cut last week. So for the next meeting will be on the 28th of January. So market participants expect to be on hold at 75% chance, quite high, almost unchanged from yesterday at also 75.6. All right. So given the high chance that the Fed will remain on hold for the January meeting, we need to have a rather weak number, non-farm payroll data and other important data to look out for as well, in order to shift this needle to bring it down to below 50%. That means allowing this 24% chance to slip back up to around 50% or more, to see that fourth interest rate cut to come in earlier than expected. So the data got to be rather weak. But nevertheless, the dollar still continues to remain on the weaker tone of the story. If you look at the US dollar index over here, it continues to slide down below the 50-day moving average that got broken down on the 3rd of December, and now trading to test the next support level at 98.03 before heading down towards the lower boundary of this sideways range configuration of the US dollar index that has been in play since 1st of July this year, with the next support coming in at 97.2, followed by the key medium-term sideways range support level of 96.55. Right, so that's for the US dollar index key level to watch. Now back to the Fed Watch tool. So if you look at the aggregator tab over here, market participants are now looking for the next interest rate cut to come in much earlier. Previously, it was somewhere around April and June before the FOMC meeting last week. So based on the latest data right now, market participants now expecting 60% chance for the Fed. Okay, let me expand it bigger. Yeah, for the Fed funds rate cut to come in on the 18th of March meeting. That means that's the second meeting of next year. All right. So first meeting, no cut, maintain the momentum of 2026 at 28th of January. So 18th of March, the second meeting of 2026, the market participants are assigning a rather higher odds of 60.56% that the Fed will engineer the fourth cut to bring it down to 3.25% to 3.5%. But however, then thereafter, the market only looking for the fifth cut to come in on the 29th of July or on the 16th of September 2026 FOMC meeting, with a chance of 69.35% to 97% chance to bring it down to 3% to 3.25%, and that would end the year at 3% to 3.25%. If you look at the last meeting of the year, 9th of December 2026, 65% chance that the Fed will be at this rate of 3% to 3.25%. So market participants are still looking for 2 interest rate cut for 2026. So that needle will change based on whatever data print that comes out today. All right, so later I'll touch more about that data print, all right, which is consists of the non-farm payroll data and the unemployment rate, which is pretty much closely watched, and as well as the S&P Global preliminary reading PMI data for US that is going to out later as well on the same day today. Okay, so let's sum up the first segment of the daily dose. Let me now move on to the second segment, which is the intraday technical outlook segment over here. So let me expand my screen. All right, so let's start with the FX market. Okay, so the FX market, let's take a look at the euro dollar in first step. Right, so the euro dollar continues to bounce as expected, but can't have a proper breakthrough above the 170.60 level. Right, so there's actually a bit of whipsaw here. Okay. Let me push it up, 1760. Okay, this level. Okay, can't really have tested yesterday. Come down. Then thereafter just trade sideways in today's Asia session. So no change in the level. So I cannot adjust my pivotal support to this level here at 117.22 over here, this level, which was the swing low of last Friday. So given the fact that there's can't have a proper bullish breakout above the first resistance of 117.60, so I'll be still using the same levels to maintain this bullish bias as it continues to shape a series of higher low within this minor ascending channel that is still in place since the low of 21st of November. Pivotal support at 117 figure level for now, unless we have a bullish breakout with an hourly close at 117.60, that will tighten my pivotal support to 117.22. All right, over here. Next key levels to watch out for 117.90, 118.20 as we maintain our bullish bias trend for the euro dollar. So 117.90, 118.20 is a Fibo extension level of 1.236, 1.382, taken from this ongoing impulsive up move sequence that has been in place since 21st of November low, and as well as the upper boundary of this minor ascending channel. Graphically, if you look back in the past, congestion area of 23rd of September, minor swing high of 23rd and 24th of September over here at the 117.90, 118.20 level. Only a bearish breakdown below 117 figure level will invalidate today's bullish bias view to see a minor corrective pullback, extending its weakness to expose the next near-term support zone at 116.75, 116.55 next, which confluence with the lower limit of this minor ascending channel. A breakdown below 116.55 will see a deeper slide to test the 20-day / 50-day moving average, confluencing very closely at 116.15 next. So that's for the euro dollar. Next up will be the sterling pound, the sterling against the dollar. So sterling dollar continues to trap in the sideways range. Yesterday, test our first resistance level, which is my upside trigger level at 133.96. Can't break it and starts to trade sideways. So no change in the levels. So continues to watch this 133.96 over here as my upside trigger level to increase the odds of our bullish biasness that we have on the sterling dollar as it continues to trade above the key 200-day moving average and continues to test the lower limit of this minor ascending channel, which is the minor ascending channel support drawn from the low of 21st of November. So still no change in terms of key levels. 133.50 short-term pivotal support level, maintain that bullish bias, but that bullish bias odds will only increase when we see a clear bullish breakout above 133.96 with an hourly close above it to potentially expose the next intermediate resistance at 134.50, 134.90 next, which confluence with a Fibo extension level as well. Only a bearish breakdown below 133.50 will negate the bullish bias to trigger off a minor corrective decline sequence, exposing 133.25 followed by 132.70, which is the next near-term support level to watch that confluence with the potential intersection of the 50-day and the 20-day moving average, which confluence with the former minor swing high of 27th of November and 1st of December. So that's for the sterling dollar. Next will be the Aussie dollar. So the Aussie dollar, like I mentioned in today's Asia session, it did a sell-off at the start of the Asia session at 8 a.m. Singapore time, almost breached the 66.30 level before heading back up again to trade at 66.35, and where it dipped up, where it did that U-turn, the U-turn dipped very closely to the minor ascending channel support that's been drawn from the low of 21st of November and also the minor swing low of 9th of December over here that previously shaped this last bounce to test the upper limit of this minor ascending channel before it did that consolidation. All right, so it's going to consolidate right here, right now. And if we do the Fibo retracement of this entire ongoing bullish impulsive up move sequence from the minor swing low of 21st of November all the way up to the minor swing high of 11th of December last Thursday, the current level confluence with the 23.6% Fibo retracement, giving us some form of important inflection area as it's trying to recover right now. So given that it still managed to recover at that 66.30 level, so I consider Asia session sell-off at the 8 a.m. to 9 a.m. Singapore time mark as a whipsaw or noise and tolerate the access to 66.15. So 66.30 / 66.15, tolerate the access for my short-term pivotal support. So you have a zone right now for today, 66.30 / 66.15 to maintain that bullish bias. Upside trigger level will be close to yesterday's US session high that can't break at 66.60. A breakout above 66.60 will increase the odds of a recovery towards 66.90 in the first step. So that's for the Aussie dollar, still maintaining that bullish bias with access at 66.15 pivotal support. So it's a zone of 66.30 / 66.15. Only a bearish breakdown below 66.15 will invalidate today's bullish bias view to trigger a minor corrective decline sequence, exposing the next near-term support level at 65.80, which confluence with the rising 20-day moving average. A breakdown of 65.80 will see further weakness towards 65.40, which confluence with the 50-day moving average over here. So 65.80 is coming very close to the rising 20-day moving average. So that's for the Aussie dollar. Okay, and lastly will be the dollar yen. So the dollar yen continues to plummet down as expected. So now breaking below the 54.90 level over here. Okay, so yesterday we do have that bearish bias. Okay, so first support level has been hit 54.90 over here. Right, so let's put it in dotted line. All right, 490. So given that this support level has been hit, I will now tighten my pivotal resistance level towards 55.60. All right, so previously we will have 56.10 over here, which is the 20-day moving average. Given that now it's now breaking down below 54.90, I will tighten it to 155.60 over here. So this will be my new tighten pivotal resistance level, right? Short-term pivotal resistance level 155.60. Oops, sorry. Let me adjust it. Short-term pivot. Okay, so using 155.6 or 155.60 tighten short-term pivotal resistance level, still maintain that bearish bias for the dollar yen. Next support level to watch will be 154.40, which confluence with the 50-day moving average. A breakdown below 154.40 exposes the next near-term support level in first step at 153.70, which is the minor swing low of 11th of November and 14th of November. Only a breakup above 155.60 will negate today's bearish bias view to retest the 20-day moving average again at 156.10. Only a bullish breakout above 156.10 will see a potential mean reversion rebound scenario towards 156.60, maximum 157.50 next, as is try to actually hit up towards this top of the minor swing high of 10th of December if 156.10 is taken up on the upside. Okay, so for now, watch the tighten short-term pivotal resistance level at 155.60 to maintain this ongoing bearish bias view for the dollar yen. All right, so that's sum up the intraday technical outlook of the four major US dollar pair. Now, going forward will be the rather choppy movement on the global stock indices due to the weakness that's being seen on the influential Nasdaq 100, driven by the AI jitters that has been in place since last 2 weeks. So let us start with the Hang Seng Index over here. Okay, so this is the Hang Seng Index. So the Hang Seng Index sell off. Yesterday we have this pivotal support at 25,445, sold off and now hitting the critical support zone, the critical swing low area of 21st of November. All right, so still recall that the rest of the other dollar major pair managed to continues to bounce off. The dollar continues to remains I would say weak beyond from the 21st of November. Like the euro dollar still continues to hold in the uptrend from 21st of November. The sterling dollar as well, the Aussie dollar as well. But very interestingly, the Hong Kong 33 can't exhibit such bullish momentum. So the Asia Pacific stock indices in general tends to have an indirect correlation with the US dollar. That means if the US dollar is weak, Asia Pacific stock indices tends to be on the stronger side, but that is not holding on right now due to the very underperformance of the Nasdaq 100 that is dragging down, that is sucking up or negating this US dollar factor. All right, so the US dollar weakness is not being in the forefront right now to benefit the Asia Pacific stock market as per se. All right, so given the fact that it's now testing this key critical swing low area of 21st of November, I would not be so bearish to turn outright bearish yet. So I'll flip to a neutrality stand for now first between 25,455 and 25,120. So unless we have an hourly close below 25,120, then potentially it may see further weakness towards our medium-term pivotal support area 24,765. Lower limit will be 24,620, which confluence with the 200-day moving average right over here. Only a break up above 25,445 will negate today's bearish sentiment to see a squeeze up to retest the downward sloping 20-day moving average at 25,790. So in order for the stronger forces of the bulls to come in, it got to clear above 26,010, 26,150, which confluence with the 50-day moving average. And if you look at this 50-day moving average in dark blue, that has kept previous rally in check on the 2nd of December, as well as on the 5th of December, preventing the rally from extending beyond the 50-day moving average, now acting as a resistance at this zone at 26,010, 26,150. So therefore, in order for the bulls to gain better traction or to increase the probability of the start of a fresh impulsive up move sequence, the clearance of 26,010/26,140 is a must. All right, so for now, neutral for now, but we got to respect if this 25,120 is broken down on the downside, then further intraday weakness could be possible on the Hong Kong 33 representing the Hang Seng Index towards the key medium-term pivotal support zone at 24,765, 24,620. Next up will be the Japan 225. So the Japan 225 also got hit by the sell-off in the Nasdaq 100. So broke down below our short-term pivotal support area. Also broke down below this minor sideways range support lower limit. The minor sideways range support broke down below the 50-day moving average, and so broke down below this former medium-term ascending channel drawn from the low of 7th of April. So right now, potentially it could en route towards the next key support level, which is our medium-term pivotal support level, which is the swing low area of 18th of November and 26th of November previously. So flip to a bearish bias stance for today for the Japan 225 due to its weak technical configuration right now. Bearish below the 20-day moving average, and also the pullback line of this former minor ascending channel support now turns into a critical pullback resistance at 49,950. Next support level to watch will be 49,085. Broke down below it will test our medium-term pivotal support level at 48,450. Only a bullish breakout and hourly close above 49,950 will invalidate the bearish bias to see today's Asia session movement as a failure bearish breakdown, to see a potential squeeze up towards 50,530, maximum 50,985, which is the minor range top that kept the bulls in check since 4th of December. So that's for the Japan 225. Next will be the Germany 30. So the Germany 30 also feared to capitalize the bullish movement at the start of the European session yesterday, and also broke down below our Titan short-term pivotal support at around the 24,235 level over here. All right, it broke down, and so broke down below this minor ascending channel support, indicating that we are now perhaps another round of choppy minor consolidation phase that could take shape, or potentially we could start to see a deeper slide to see a mean reversion decline to retest the 50-day moving average and the 20-day moving average again. So given that the 50-day moving average is coming very close at the psychological level at 24,000, which is also the minor swing low area of 8th of December and 11th of December, I would have a neutrality stance for now. So it could be a nasty bearish breakdown at the start of the Asia session today, given that the Germany 30 futures market is not trading during the Asia session. So I would have a neutrality stance for now first, and I observe how the European session evolve when the futures market open between the 2 to 3 p.m. Singapore time later. So the Germany 30 CFD index for now, we have a neutrality stance given the lack of liquidity, and also the futures market is not assisting right now for the Germany 30s yet, given that the market was only open during the 3 p.m. Singapore time. So that will have more liquidity to come in. So I don't want to be outright bearish given the lower liquidity trading situation for the Germany 30 instrument. So I will flip to a neutrality stance for now, 24,235, 24,000. If we start to see a bullish breakout and hourly close during the European session above 24,235, then could say that in today's Asia session, over here at the 9 a.m. Singapore time. So this is considered as a failure bearish breakdown, and bulls will start to reintegrate back into the Germany 30 CFD index. So the next resistance level to watch will be 24,395. All right, only this level cleared, we start to see a higher high towards 24,560, 24,620, which is the congestion area of 3rd of October and 10th of October this year. All right, so that's for the Germany 30. Okay, next up will be the US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So Dow Jones Industrial Average continues to consolidate since hitting our first resistance on last Thursday at 48,770. So still no change. The pivotal support to watch will be 48,125 over here, 48,125, with the first resistance at 48,770. So only a bullish breakout above 48,770 will increase the probability of the continuation of this bullish impulsive upward sequence to take it up higher towards 49,250, potentially 49,280, which is the Fibo extension cluster level, and as well as the intersection between the medium-term ascending channel upper boundary and the minor ascending channel upper boundary from the low of 21st of November. A bearish breakdown below 48,125 short-term pivotal support will invalidate this bullish bias view to see it sliding downwards further. That means kick-starting a minor corrective decline to mean revert back towards 47,820, maximum 47,560, which confluence with the rising 20-day moving average very closely, and as well as the minor ascending channel support as well, that confluence with the minor swing low area of 3rd of December and 10th of December. So that's for the US Wall Street 30, still maintaining that bullish bias with two key levels to watch out: support level 48,125, intermediate resistance level / upside trigger level 48,770. Next will be the S&P 500. So the S&P 500 managed to come down, toggle down, and now test the 20-day and the 50-day moving average. All right, over here, this is the zone over here. So with this 20-day and 50-day moving average that is still in holding the S&P 500 over here, I do not want to be, okay, give me the, it's not over here. Pardon me, this, let me put it right. All right, so this is the 20-day and the 50-day moving average. 6,780, 6,760, and so confluence with this dotted gray line. So this dotted gray line is the former bullish breakout line of a resistance level that was being drawn from the current all-time high area of 30th of October. So this line, this dotted gray line here also confluence with the 6,780, 6,760 level, making it a rather important inflection zone for the S&P 500. So with that, I'll be using 6,780, 6,760 as my short-term pivotal support area for today, adjusted short-term pivotal support to take into account of the latest price action that confluence with a three key elements: the pullback support line of the former descending resistance from the all-time high, the dotted gray line, and as well as the 20-day and the 50-day moving average that confluence with it, and also the former minor swing high area of 17th of November and 20th of November now turns into a pullback support. So using this slight adjusted short-term pivotal support zone, 6,780, 6,760 on the S&P 500, still maintain that bullish bias. Near-term resistance level or upside trigger level will be at 6,870, which is yesterday's US session high at the start of the US session, where there was a rally. That rally can maintain that momentum and see that choppy movement during the US session that closed unchanged. That actually has this minor losses of negative 0.2% of the cash market. So this 6,870 will be my intermediate resistance level to watch for today on the S&P 500. That will be my upside trigger level. So only a clearance above 6,870 will increase the probability of another round of bullish impulsive movement to retest the current all-time high area in first step at 6,930 next. Only a bearish breakdown below 6,760 will invalidate the recovery scenario on the SPX 500 to trigger off a deeper corrective pullback towards the next two support level to watch in first step will be 6,710, 6,660, which is a Fibo retracement level of this ongoing recovery from the low of 21st of November all the way up to the high of 12th of December. That confluence with the 50% Fibo retracement and the golden ratio of 61.8%, which is at 6,660. So that's for the SPX 500. Next up will be the Nasdaq 100 over here. So the Nasdaq 100 right now, potentially, right, we start to see that underperformance where it broke down below the 20-day and the 50-day moving average, rather weaker. So what you could see right now over here is that it could be doing this minor corrective pullback, and this minor corrective pullback could potentially retest the golden ratio at 25,580 of this previous movement from recovery movement from 21st of November low to the high of 8th of December. And also potentially you also do the retest back down to this dotted line here. So this dotted line is in fact this former descending trend line from the current all-time high that got a bullish breakout on 27th of November now turns into a pullback support level at around 24,430, which confluence with this level here. With this minor swing low area of 76.4% Fibo retracement as well at 24,300 level. All right, so this is the 24,300 level. Let me put it in writing first. Okay, so with such, then the hourly RSI is oversold, but there is no bullish divergence yet, so indicating the lack of a recovery. So potentially there could be a bounce. So a bounce level to watch out for will be yesterday's breakdown level, where it broke down on the 12 a.m. mark Singapore time Wednesday before shaping we call it a consecutive series of bearish candlestick on an hourly basis from 4 a.m. Singapore time yesterday, and now in Asia session it continues to do that weakness. So I will have a rather tight short-term pivotal resistance for today using yesterday's trigger level, now turns into a critical pullback resistance level at 25,160, 25,160. So using 25,160 short-term pivotal resistance on the Nasdaq 100, we do have a bearish bias. Next two support level to watch, because right now it's trying to break below the support level at 24,920, will be 24,760, 24,580 in the first step. So once it hit the 24,580, so 24,760, 24,580, which the golden ratio. Once it hit the golden ratio at 24,580, I'll be on the lookout for signs of bullish reversal scenario. One example will be any bullish divergence on the hourly RSI. That could give us an indication that this could be a turning point for the Nasdaq 100. Or if there's no turning point, there's no bullish divergence, potentially the next support level to watch will be at 24,300 next, which constitute with a 76.4% Fibo retracement, the minor swing low of 24th of November, and this dotted gray line here, which is the former descending trend line resistance, now turns into a pullback support, confluencing at 24,300. Only a bullish breakout above 25,160 will invalidate the bearish bias on the Nasdaq 100 to see a retest for yesterday's US session high, which was also our upper neutrality range at 25,380. So yesterday we have a neutrality zone. So it broke down below our neutrality zone yesterday. So only a breakout above 25,380 will potentially see a much more potential bullish recovery coming into play to see a retest of 25,760, 25,830 in the first step for the Nasdaq 100. All right, so that sum up the intraday technical outlook on all the broad-based cross asset classes. Not all of them are moving in a uniform basis due to this ongoing weakness in the AI-related names that causes this kind of ununiform behavior among the broad-based global stock indices. Now let us move on to the commodities market, which I will touch on the gold XAU/USD first. So for gold XAU/USD, sideways movement, okay, can't break above 24,355 level. So that was my resistance level that has been made on last Friday, and in the entire of yesterday's Asia session, it just traded sideways. Okay, 23,000. Let me put it 55. Okay, over here. It can't break above the 2040. Come on. So it can't break above this upper limit, which is the 4,355 level, which indeed it tries to break during the European session, can't break and starts to do that pullback. So no change, still having that pivotal support level at 4,267, 4,243 to watch for today as continue to maintain this bullish bias in this ongoing sideways consolidation. A breakout above 4,355, potentially seek out a retest of the current all-time high in October, 4,380, followed by 4,430, 4,440 next, which is a Fibo extension cluster level, and the upper limit of this ongoing medium-term ascending channel drawn from the low of 28th of October 2025. Only a bearish breakdown below 4,243 will see a deeper minor corrective pullback to retest 4,205, which is the rising 20-day moving average, maximum 4,155, which confluence with the lower limit of this minor ascending channel. So that's for gold XAU/USD. Lastly will be the West Texas crude oil. So very quickly, the West Texas crude oil, if you look at the daily time frame chart, it broke down below this minor range support level that was previously in place since 17th of October, and right now looking to test the medium-term support level of 55 level psychologically, which is the low of this year. So a breakdown below this 55 level from a multi-week perspective, this is a daily time frame chart. It may test the 50-50 level / 49.10 level over here, which is the 0.76 people extension. Okay, now going to the intraday chart, which is the hourly chart right now. Okay, so the hourly chart, yesterday we are looking for at least a bounce back towards the 58.20 level. The bounce didn't take shape and broke below the minor range support level. Now turns into a critical pullback resistance, which is my short-term pivotal resistance for today. 57.21, sorry, 57.21, 57.54. So with that, I will flip to a bearish bias and follow the trend movement to the downside. Next near-term support level to watch will be 55.80, followed by 52.23, which is this minor swing low here. If you go to the daily time frame chart, very clearly you'll be able to see that. All right, the swing low of 5th of May and the swing low of 10th of April this year. Okay, only a bullish breakout above 57.54 will invalidate the bearish bias to indicate that yesterday's breakdown was a bearish failure, breakdown to see a squeeze up back towards 58.20, 58.70 next, which confluence with the downward sloping 20-day moving average. So that's for West Texas crude oil. Flipping back to a bearish bias using 57.21 / 57.54 as my short-term pivotal resistance level. All right, so that sum up the intraday technical outlook on all the broad-based cross asset classes. Now let us proceed to today, heavy data flow day on the economic calendar. So what are the key data to look out for other than the non-farm payroll data? So going into the European session over here, we do have UK unemployment rate and unemployment change. So that's for the month of October. So that will be a potential driver for the sterling dollar as well as the sterling crosses. Then thereafter, we have a slew of global PMI preliminary releases for Germany and the Eurozone. So for Germany, you'll be at 4:30 p.m. So market participants will be looking very closely to the manufacturing, we call it activity for Germany. So the consensus right now is looking for a slight improvement from 48.2 to 48.5. So if it starts to go higher than consensus at 49 or even back to the expansionary mark of 50, that could add a bit of boost for the euro dollar. And if you look at the aggregate one, that will be up at 5 p.m. Singapore time. So they will be the total Eurozone aggregate that consists of Germany, France, and other Eurozone members. So the manufacturing PMI flash data for December, market is expecting a continuing improvement to 49.9. So if you look at the Eurozone manufacturing PMI data, it has been slowly improving over here since August and September. Since August, all right. Since August, it hit to go above 50. That after it dipped slightly, but it didn't actually drop. So it's doing some signs of also an improvement. So if you look at the consensus figure over here, market is expecting a slight improvement to 49.9. So if we start to go to 50 and even beyond 50, like 51, that could also add a boost to the euro dollar. Then thereafter, at 5:30 p.m., we have the UK manufacturing PMI flash and the UK services PMI flash for December as well. So market participant is almost looking at almost the same rate as the November one. So for manufacturing, market participants are looking at 50.5 from 50.2 previously in December. And for services, also a slight improvement to 51.5 to 51.3 over here. Then going down, that will be the important non-farm payroll data that will have a very, very interesting combination of October and November. So this November, this headline number, the headline number that come out is not a single month data. It consists of October and November. They combine together. So what market participant is looking at a very low ball figure of 40K job added. So that's indicating a very, very, very weak labor market data. So if market came in within expectation, the number came in expectation or slightly improve, that could cause a bit of near jerk reaction. All right, so it came in above expectation. That means because it's a very low ball number. So let's say it coming at around 100K. So that could actually see a bit of near jerk reaction in the market because market participants is expecting the unemployment rate for November to be at a very high level at 4.4%. So if you look at 4.4% over here, is the highest level since October 2021. All right, so if you look at the 10-year trend, so what I could see is that the unemployment rate has started to tick up, and at 4.4 is the highest level since October 21. and even some economists forecast to be higher than 4.4, so around 4.5 to 4.6, and even Trading Economics is forecasting at 4.6 level. So despite if the non-farm payroll headline number came in more than expected, because 40K is a very low ball number, it could be easily beat the expectation. But if the unemployment rate continues to be lackluster at 4.4%, and we're still beyond 4.4%, that could allow a wild swing of the US dollar. That means the US dollar may gain strength a bit, but then thereafter the US dollar may start to see further weakness going forward if the unemployment rate continues to be rather lackluster. Then the stock market will react depending on how the AI related stocks move. So given that if the unemployment rate continues to remain high, despite a bit on the non-farm payroll data, Fed funds rate will be continue to show at least 2 interest rate cuts for next year, keeping alive the liquidity injection by the Fed in 2026, and that could potentially support other industrial stocks, healthcare stocks, and even the financial stocks, given this ongoing yield curve steepening, where the 2-year Treasury yield dropped further than the 10-year Treasury yield due to this proxy of its monetary policy, the Fed monetary policy. So then it all depends on how the AI stocks relate, and that could see another disuniform movement among the major US stock indices today. So that is the key data, all right, for at 9:30 p.m. Singapore time. Then thereafter, at this 10:45 p.m. Singapore time, we have the preliminary S&P Global Compound Services and Manufacturing PMI data for US that will be out as well. So this could be also another impacting movement, given the fact that it's leading economic data, and market will be focusing on the services sector. So services sector constitute close to 3/4 of GDP growth in US. So for the month of December, market continued to expand it at the same rate at 54.4 in November. And bear in mind that the services sector has been pretty much resilient for the entire year for 2026 in the US, despite the Trump reciprocal tariff. So something to look out for on the headline number for the services PMI data that could impact the global market movement. So if it starts to dig down below 54.1, that means below expectation, say coming at 53 or 52, that could increase the chances for the Fed to be more dovish in 2026. So something to look out for. So that will be at 10:45 p.m. Singapore time. All right, so that sum up the key movement during the start of the European session and heading into the US session. Then thereafter, in early Asia session tomorrow, one key data to take note of before the start of our daily dose at 11 a.m. will be 7:50 a.m. That will be balance of trade for Japan. So that could potentially influence the dollar yen and the yen crosses. All right, so with that, that sum up today's daily dose of market insights. I'm Kelvin here, signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.